Hi everyone, welcome to the live webinar. You should all be able to see and hear me. We are in a live mode, I believe. Let me know you can see and hear me because mine sometimes shows that we're not necessarily on air when we are. Now, fantastic news for you. I've got a bunch more stuff for you. Hello, good evening. Just let me know you can indeed see and hear me on there. Okay, just put it into the chat box as well. Good, fantastic. Now, let me share the screen straight away because your time is precious. And I'm going to do things slightly differently this week. I want to start off with explaining what I do, why I do it in very brief terms, in 60 seconds. My goal ultimately stems from here we go, from this, my campaign to teach 1 million people, campaign for 1 million, how to invest better. Okay, so if I can just take up 60 seconds of your time. I created this because of all the things that I do, all the books, all the talks, everything else there, the Canadian Prime Minister, it made sense to share that going forward, not just in book format, but in videos and so on. So a whole bunch of free things, including these webinars. Because I want to teach 1 million people, and free courses, 1 million people how to add an extra million to their pensions across their lifetimes through better investing. And it involves hard work. That was 1 day ago. That was written 2 days ago, 5 days ago. So there's quite a bit of content, videos, and so on. And they're like, oh, there I am looking younger. Jeez, and that felt old at the time. Okay, so that's the reason why it's done, and because the problems that we're trying to solve are people like Neil Woodford, who just underperform, and fund management, active underperformance is rife, but also because the super rich, UBS rich clients get Goldman, PIMCO strategies with an extra fee. They have access to stuff which, because of my industry background, I get access to and I want to share with you so that you get the information, the knowledge, the know-how, and the data, and then hopefully you can do something with it, as opposed to, as has happened in the UK, for instance, as opposed to the US and elsewhere, where it's similar kind of numbers, keeping your money just in a bank account because you don't know what to do. And one of the problems this leads to, and I'll just give you the UK example, let alone US and elsewhere in the world, is mental health issues, worry, stress. Okay, so you might know this already because I've told you this before, but I wanted to start off before we do the stock market update proper, just to say to you that that's why I do it. All the content that I produce for all of these people who've paid me to speak to their clients over the last 25 years, it just made sense sharing it. All right, so that's what I wanted to get across, why I do it. The end goal, the call to action, everything that I'm teaching you is essentially so that you for yourself can create what I do for clients, which are what I'd call model portfolios, okay? Portfolios suited to them. Now, this is not going to be suited to everybody. You might think, oh, I'll take that then, Alpesh. Why didn't I just copy that one? 34.2% per annum historically. It doesn't mean it's going to do it in the future. Why don't I just copy that? Well, because of this reason, and this is the bit people don't get. Obviously, everybody wants 34.2. Guess what? I'll guarantee you, you'll never get a year with 34.2. It could be zero. It could be negative in 1 year. It could be 70% another year because of this. Okay, so part of my job for clients, by teaching them either to do it themselves or for existing clients, doing it for them and then checking, is I spend all my time working this out for them to make sure that matches their appetite. Because the two reasons people with good, whether it's portfolios or stocks, mess it up is panic or boredom. Okay, and I'm going to show you that in a second. And they say, oh, I'll have that, I'll have those. No, because within 5 minutes, they'll panic because of this, or they'll get bored because 9 months went by and they didn't get the return they wanted. So my job is to make sure they're not irrational, that they're knowledgeable, and they have the data to create for themselves. And I guarantee you, if I gave this portfolio 99.9% of people, without knowing what this means, what the volatility part means, okay, you should be able to see my mouse moving around, I hope, will panic or exit. So for some, what will be more appropriate here is a volatility of, say, 10%. And I'll explain what that means later in this, because then that means the drawdowns, the amount they're ever down, reduces. Okay, and by the way, in a bank account, that's zero and the drawdown zero. Those two numbers are zero, and that's about 4%. Got it? Okay, so you can sort of see risk and reward. Now, that's my job. That is my job for my clients, is to get them to that stage. How do we get them to that stage? Because I talk about the markets a lot. How do we get to that stage? Well, we build it from scratch We take 10,000 companies and walk them through it, talk them, give them unlimited access. We give them all the data and the knowledge, and I'll talk about the market update. So now you know, we take all this data, we filter it, and then we work out what suits their risk appetite and their returns. Why don't the fund management industry do this? Well, several reasons. First of all, they've got 3 buckets: low risk, medium risk, high risk, and they'll shove people into each of them because it's commoditized. You're on a conveyor belt. Secondly, they get paid by the amount of money that they have, the amount of money that they assets under management. So what happens is, because they're getting paid by assets under management, what they will do is they will break that money, because they've got so much money from marketing, into UK funds, US value funds, growth funds, so geography, style, and theme. So value, growth, income, or theme. AI. And you might think, well, surely some AI stocks are good. Well, no, because it all depends on looking at all of these. That's why Warren Buffett does so well, because he's not restricted by geography, style, or theme, although he always bets on America, which is big enough. We tend to look at, by the way, none of these meet my criteria. See that value growth rating? None of them meet my criteria. So none of these stocks I've just shown you would be suitable for my portfolio, my son's junior ISA, or my wife's sipp. And the reason is, if you do not filter that closely, then you are speculating and gambling. If you pick on only one country, like, so I'll only pick UK ones, you are gambling. If you don't look at undervalued companies which are growing, you are gambling. And we've got the data, and I'll show you in this webinar to show that you are gambling. If you do not look at what other research which has won Nobel Prizes, for instance, the research of Eugene Fama, which is incorporated in here, shows, then you are gambling. Okay, and private investors, in my experience, are more than happy to gamble their pension in Las Vegas. They just don't think they're doing it, but they are, because what they want to do is try and double their money in the shortest period of time. It doesn't work like that. The get rich quick, go to Vegas. Okay, so we look at data and we say, historically, how has this data performed in the historically? That can't guarantee the future, but is there a rationale why it should replicate the past? For instance, undervalued companies which are growing tend to do better than ones which aren't. Common sense will tell you that, but actually data and analysis will tell you. So anyway, that's enough of that. I found this from earlier, from 4 years ago, where the Investor Chronicle had covered me. Warren Buffett, make way for the influencers. Since he's retired, I'm not saying and anywhere near as patient as he is. I'm certainly not as patient as Mr. Buffett, and I won't last as long as him. But it was nice because they covered me in it when I had 37,000 followers. It's more than 10 times more since then. We're closer to 440,000 now with one of these little beauties. So the campaign for 1 million to teach 1 million people how to be better investors, we're on the way. We're on the way. And more people on the free materials, which I'll give you. Okay. So thank you all. Peter, I'm so sorry in Auckland it's so late. I apologize. I will try and do these sooner. Chetan, I think you're already in the program, so you don't need to watch this. Joseph, similarly for you, my friend, you don't need to. You're more than welcome to, but you're on the program because the private one I've just posted with all the slides and much more on the private Telegram channel. Okay. I was on the BBC yesterday talking about the trade deal. I don't know if you caught that. I don't know if you caught the logo as well on air. So that was interesting to do. I might come to that a little bit later. I want to really talk about investing and getting your portfolio right rather than, and the mistakes that people make and where I think things are, rather than just generally have a macroeconomic talk. That we can do that a bit later. This I'm still working on, this book. The FT will publish it in due course. It'll be book number 19. Hi, Jeremy. Hello. And again, apologies to so many of you that I was a little bit, sorry, that this webinar is a little bit late, that it's at 9 p.m. and not earlier. Okay, but I have got some wonderful, wonderful stuff for you. For those who don't know, and I'm going to give you a free copy to download of that one on here in just a second. Why don't I? Yeah, I'm going to do that in just a second. As well, top exchange returns over the last 10 years. 10 years is pretty good. I don't want to look since the Second World War because the world was a different place. So the three winners of these, we'll look at their exchange traded funds in a moment as well. Okay. I haven't had a look at the India one. I'm hoping a bit of panic would have made it cheaper to buy into, because long term it is well worth buying. However, it looks like there hasn't been panic. By the way, investing, it's an amoral business. Some would say immoral business. It's actually up as I speak. So it's actually gone up. So I was hoping maybe a tank a little bit and, get a good return. Over the last 5 years, it's gone up 155%. Anyway, over the last 10, it's done that. That return doubles your money in 5 years, and that's just the index. So you could just save yourself a lot of trouble. Now, some of you will start thinking, oh, by the way, and if you're British, your pension is pretty much over the last 10 years not kept up with inflation, I'm afraid. So when people say, why don't you just track an index? I'm going to pick the right one. Okay. Now, I'll talk a bit more about some of these. We're not just going to randomly talk macroeconomics, although as I often say, I have a master's degree in economics and politics, and I can tell you for this stuff, it's utterly useless. Okay. They're history degrees, basically. They're history degrees. That's all they are. They're not prediction degrees. In case people think, oh, you must know lots because you've studied these subjects, so you must be an expert. No. Okay. They're history degrees, and the past sort of tells you a bit about the future, but not much. Okay, so we'll look at some of those country ones a little bit later on. As you know, I have a key focus, which is this, but I also have all the data for this. It's just that when you've got 10,000 US securities to choose from, the 350 largest UK companies, because after that they become small cap. The 350 largest UK companies, they just don't get in the league tables. It's a bit like pick a World Cup winning team. Guess what? They all end up being bloody Germans, Argentinians, or Brazilians. I'm sorry, the England team doesn't make the top 11. Maybe I'm being unfair, but you get the point. So that's the problem. People say, you've got a bias towards the US. No, I've got a bias towards making money. Okay, I've got a bias towards bloody making money. I'm not racist in my stock picks. I loved this. If any of you missed it, surprising things happen in the world and in turn the stock market. In Buffett's view, if you're someone who gets excited when things look good and afraid when things look bad, then the stock market is a terrible place to get involved. If you're excitable, please leave, because the stock market is not for you. Okay, if you're a gambler, it's not for you. I want to bring people peace of mind. That's the job of a decent portfolio. That's why this guy's alive drinking that crap. He's alive at 95 because he's calm. His calendar's empty. I want to be like him. If it makes a difference to you whether your stocks are down 15% or not, you need to get a somewhat different investment philosophy. Okay, the world is not going to adapt to you. You're going to have to adapt to the world. He's put it so much better than I could. It's just simple and it's perfect. Okay. Now, some of the panic headlines, which I like because I'm substantially holding cash. So if this happens, that's in business, 100 years of market history suggests we could fall another 18%. We'll come to that. If it does, I'll be over the moon because I'll be able to pick up bargains. And that means we'll do what we did in 2023 and 2024, which is make a bloody killing unexpectedly. I didn't expect 2023 and 2024 to be so good. I didn't. Okay, I just thought these look cheap, I'll buy them. I didn't know they'd overshoot so quickly. That was it, right? Mark Mobius says his fund holds 95% in cash on trade war risks. He's good. He's good. Mobius is one of the few people worth listening to. Okay. PNB Paribas 190% downside. Okay. That's what the smart money's saying. That's the smart money. Doesn't mean the smart money's right, but it's what it's saying. So we'll drill down into the data. All of this, fine. It's good talk, but let's drill down into some of the data. By the way, the poll, FTSE higher by the end of 2025 from today's levels, half of you say yes. You may well be right. Let's look at the Dow. And by Dow, I mean the US markets generally. So don't feel that, oh, does it mean the Dow, not the S&P? Okay. So I want to show you something else. Stock market participation rate. One of my jobs, by giving people peace of mind for their finances, is doing this. I'm a child of the Thatcher era, increasing stock market participation. That's what the campaign for $1 million is. It's to make sure more people are managing their own pensions through SIPs and ISAs or 401ks, wherever you are in the world, doing it. Because guess what the richest country in the world does? It has the highest percentage of shareholder population. I don't think that is a coincidence. UK, you might think, wow, 1 in 3 people, 33%. No, that is through pension funds, IFAs, and wealth managers. I mean, this is slightly, but it's far more individuals doing it themselves. The Americans tend to have well-informed people who tend to do it themselves. Okay. And that's part of what I want. I can't think of an easier way of having a side gig, a side hustle than managing your own pension, basically cloning myself, replicating myself. So if I spent my whole life earning money doing whatever, laying bricks, whatever it is, the job is to then replicate myself and avoid the twin traps which cause problems, panic and boredom. So one of the things we started doing for clients, and you'll like this, Joseph, is we actually do a walk forward, what's called a Monte Carlo simulation of their model portfolio for them, so they can see how it would perform statistically going forward, the extreme highs, extreme lows. It's just to manage those expectations so they don't panic or get bored, because those are the two main problems, and avoid them from trading their investments. Third of Britain say financial anxiety keeps them awake at night. You can assume the same is true also for the US and New Zealand. We've got clients in Canada and everywhere else. And part of my job is to try and, by giving them those model portfolios based upon this data, and stop them from trying to trade their investments or panic, basically move them closer to the quality companies which they can hold for longer. But if they want to trade, and by trade I mean hold for, say, just 12 months, so shorter term investing, 12 months, show them both the volatilities, but also ideally they have the kind of companies that, worst case, they could hold longer, but explain to them what the movements and the dangers and the risks are of doing that, so they can match their risk appetite to what they're holding. This I did in the 5 years to 2020. Now we're 5 years on, and guess what? That gap still exists. This is why the Americans get rich over the preceding 5 years. And I want to show this one because I want to show you, well, what's happened 5 years later? Same bloody thing. Actually, the gap's got a lot wider. The Brits, minus 12% in those 5 years. Okay, their typical pension went nowhere. The Americans went somewhere between, if they were just tracking indices, no stock selections, just tracking indices. And you don't have to do stocks, because you can do exchange traded funds. There's 6,000 of those which track various indices. There's AI, exchange traded funds, and all sorts of others, which I wrote about in my Financial Times columns 25 years ago. It's been now, God. NASDAQ, 128%. So they either more than doubled their money or increased their pensions by 50% in that period, whereas the Brits didn't. And that poverty gap gets wider, and that's why the Americans, and this then replicated over another 5 years, actually got worse. So I wanted to show that. Now, at the moment, some of you might be thinking, well, okay, this is all well and nice, but what about me wanting to get in? Look, if you're going to be like this, those are the drawbacks. Take a picture of this. Please take out your phones. Feel free to take a picture. I created this for my clients, but I'm sharing it because I don't think my clients will mind me sharing it. Okay. And it shows you the drawbacks for each of these. Now, I would say, just so you know, I'm sort of here at the moment. Okay. 2023, I was definitely here. And I didn't mind that drawback. 2024, I was definitely here. Okay. For most of the year, there might have been a month or two where it was like, ooh, I think I'll wait. But at the moment, I'm still here. That doesn't mean I know the future better than anyone else. I might be wrong to be here. Only hindsight will tell us. But this is suited to my personality at the moment, my risk appetite. Middle-aged man, one kid, wife, etc., etc., etc. You can't be me if you're in your 20s. You can't be me if you're in your 70s. You can't be me unless you've got 3 Lamborghinis, 2 Ferraris, and 2 private jets. I haven't, obviously. Got a Lime bike available at any time I want. My point being, you can't be somebody else in investing, because their risk profile will be very different to yours. And it's not a question of, oh, Alpesh, what are you doing? Can I copy that? Okay. I'll answer all of that in a second, Raheem. Okay, so where are we at the moment? We're still here, I think. So I'm still largely in cash, though I'll tell you what I would buy if I was here. I'll tell you some of the things I don't mind, but I wouldn't go in with both feet. I'd probably do little. I'd do this. I'd sort of do more, a little bit at a time. Maybe, sorry, more like this, the risk-loving strategic. Okay, so I'll tell you that, because what I'm doing doesn't matter. What matters is, as long as what I suggest is reasonable for somebody else to do based on their risk profile, isn't absolutely insane. Okay, and I don't think this is insane being that. That'll just make you more like Warren Buffett. Okay, I'm just being a bit more cautious because I'm more at a stage where I want to protect more of what I got and have a quiet life. So I still think we're here at 0.4, which means this bit, we're still here, which means I think there's a danger of this. Now, could we get a V shape? We might. I don't know. I don't have a crystal ball or time machine. That's not my job. It never has been. My job is simply to say, well, when it's like this, I'd rather sit it out and wait for the storm to pass because I might pick something up cheaper. Now, some of my colleagues, like Warren Buffett, will say, no, I'm not going to sit it out. I'm going to keep hold of my portfolio substantially, and I'm not going to exit anything. And then they'll say, I've got a ton of money coming in fresh, but I'm not going to invest it. So they're a bit like me, and they're a bit not. They're both in and out. Okay. Whereas I'm substantially out still, not because I think it's going to fall. He doesn't think it's going to fall either, but just because we think we might be able to pick a few things up cheaper. I'm very cheap like that. Okay. And if you disagree with me, you can edge in 10% of the time personally, and you know what the risks are, because I've told you the risks now. If you do that, it's this. Okay. You'll have more financial stress than me. And you might as well, I'm happy to take some financial stress. Erase or link. I'm happy to have more financial stress. I don't want more fun. I don't like stress. Okay. And you might think, oh, no, I'm going to do this. And you might think, oh, shit, no, I can't do that. And that's the major problem. Private investors think they can take more stress than they can. No, they can't. They panic. Okay. And they lack the time, discipline, what's involved. So that's why I think most of them, they're better off being down here. That's all. They're better off being down there. Most private investors, they don't think they are. They all think they're bloody heroes. Okay. They all think they're keyboard worrying heroes. They're not. They should be down here, most of them. Okay. So most of my clients end up here. In other words, they end up with a model portfolio, roughly 18% volatility, or one of the low volatility ones, and some of the quality 5+ companies, which some of the higher risk ones will then do 2 times leverage on when it's not a daddy bet. And that's it. Simple. This one tends to, the 18% one, tends to roughly give about a 28 to 32% return per annum historically. Not every year. There'll be negative years, there'll be positive years. Examples being 2022 when we're holding cash for most of the year. And this is the bit people don't get. That's what volatility implies. Okay, will the future replicate the past? Well, it always has done, but it isn't guaranteed to, and it won't do it in the same order. So if you get 15% per annum, you double your money in 5 years. If there's a tailwind, it might happen in 3 years because you get a bigger return. 15% is just the S&P. You don't even need me for that. Some of our portfolios historically have generated over 32. Over a couple of years, they've even generated more than that. But assume those are 2 lucky years, because I want you to focus not on the good years, but the bad ones. Like 2022, I told cash. 2018 was surprisingly rubbish. I think it might have even been slightly negative. I didn't know it was going to be. Okay. It's a bit like house prices. If you buy a house in the 1980s, it might double in 5 years if there's no recession, and in 3 if there is if there's a recession, it'll double in 5 years. If there's no recession, it'll double in 3. That was houses. But every day the prices might vary. I wish I could make it more certain than that. My job is also more subtly to do this. Imagine that's what you want for your returns. Okay, you want a line that goes up like that, don't you? Everybody wants that. So if you have one security which goes like this, and another security in an ideal world which goes inversely like that, then those two combined give that return with less volatility. So you get the same return of both securities, the same average return as both securities. Let's say both generate 30% per annum, but none of the volatility of either of them. Okay, because that moves up, cancels that one. That diagram is a depiction of what won Harry Markowitz the Nobel Prize in economics. Okay, that's it. That was probably the biggest breakthrough in financial economics in the last 50 odd years. That's part of my job. Guess what? Sadly, it's not that simple. It's not that easy. We do try to do that, and that's what the model portfolios now describe to people. And the reason I talk more about the model portfolios is it was a bit of a breakthrough, because we thought if we just give people this data and they formulate their own portfolios based on that, well, why don't we actually show them how it performed historically and the likely, what's called the Monte Carlo simulation forward, what it might do, so they get a better idea. I don't know why I didn't think of that sooner, because that manages their expectations, prevents panic. Anyway, Microsoft, you're paying $28 for every future dollar of profit. NVIDIA, you're paying 19. Cheap historic levels. Yeah, will I get in right now? No, I'll show you. Okay, what's really cheap? Some of these banking, but they've been cheap for bloody ages. Okay, so if you're going to elongate your holding period to 5 years, it's very easy for me to say buy all these green ones, okay, and some of these big red ones. But you're going to panic and get bored in those 5 years. So that's no good just saying that. So let's have a look at it in more detail for you and tell you what I like at the moment in particular and what I'm waiting for and what's going to double my money over the next 2 years, if not 1 year, I think. But if it doesn't, but I'll show you what I think and why I'm not buying into it with both feet right now. By the way, lots of earnings coming out. Wednesday, after market close, you've got a few coming out today. Some of the big ones have already happened, obviously. Okay, so take a picture of that if you wish. UK exchange traded funds versus the S&P. We did this little experiment where we looked at those, and we do this for clients. Which ones were up more than the S&P last year? Okay, which have ridiculously low volatilities, all right, far lower than the S&P. All of these here have a lower volatility than the S&P. Have at least doubled your money in the last 5 years, and when the markets fell, didn't fall as far as the S&P or even rose. So really unfair criteria. It's a bit like asking a Ford Escort driver, can you beat a Ferrari? Okay. So we looked at these, and of course, there's no guarantee gold's ever going to repeat what it's done. So you might ignore some of these. The biggest problem I've got when I look at those at the moment is I love them. They're great. As a basket, they do well, doubles your money from 2023 to 2025 in 2 years. Just 2 years, you doubled your money with some of these, and they're low volatility. The problem I've got, would I buy, hold, or sell? Well, if I own it at the moment, I'd probably continue holding it, so I wouldn't sell. I'd hold. And if I don't own it, my worry about buying at the moment is this is overbought. When that's overbought, there's a lower probability it'll continue rising. Of course, it has kept rising consistently. Okay, and you might say, well, so much for your bloody probabilities, Alpesh. Okay, I personally prefer getting into this just when this is right. So these kind of points and staying in, okay, during those, and not being in when it's like this. Okay, so being in like that, whoops, up to there, and not being in when it's sort of falling, but being in like that. Now, that's what, 3 decisions in 5 years you had to make, and that took you from 500 to 2,000. Pretty easy, wouldn't you say? So that's an easier way for people to do it. But again, boredom will cause them, or panic when that happens, will cause them to get out early. Boredom and panic are the 2 reasons why you will F up your pension. And part of my job is to mentor and handhold clients to make sure they don't do that when they're onto a good thing. So that's my view on this, but it's not the only one. There's a whole load. The point being, you can find low volatility through exchange traded funds, which are often overlooked. And this is an example, but it's still going to mean that you've got to avoid boredom and panic. Okay, you're definitely going to panic here. All right, and you're definitely going to get bored during this period. You can go, Alpesh, it's been a year and nothing's happened, or 6 months, 9 months, right? So they're your 2 biggest enemies, boredom and panic, when you've got something good. The reason we look at all of this, very simple. Nobel Prize winning economists and research, I'll share that in a second. I need this to be a 9, 7, 8, 9, or 10. It is based on undervalued companies which are also growing. That is the simple holy grail of investing. Can you find companies which overlap and go into value, growth, income? So go into that little bit there. Okay, if you don't believe me, just ask Nobel Prize winning economists, or Warren Buffett for that matter. Croky is from Goldman Sachs Wealth Management. I'll show you the formula later. Basically, are the companies in the top 25%? If they are, 30% per annum is what that as a basket generates per annum. Not every stock in the basket, not every basket every year, because in the financial crisis, nobody did. On average, long-term, 30% per annum. So we need to tick that box. That's all I'm saying. We need to tick that box. This is probably the least important. I'm just looking for recent momentum. More important, that might even be 12 months rather than 6 months, but keep that separate for now. Sortino from the hedge fund industry, my own industry. Okay, over there, price earnings growth, undervaluation, but it's actually these first 5 I want to be green. Again, alpha less important, but it's in there. Okay, so let's have a look at the past week. Ooh, Microsoft up 10%, but I'll show you that in a second and why I'm still Personally, I'm not in, but if somebody else wanted to get in, they know what the risks and rewards are. And it's one of those which is part of my quality 5+. I don't have an issue. I know it'll double my money in the next couple of years, but I'm just waiting to pick it up even cheaper. And you might say, well, bloody hell, mate, 10% up. You could have picked it up before that, couldn't you? Yeah, but it's okay. I'll wait. I mean, why has Warren Buffett got 350 billion sitting in cash? If that's such a good purchase, why isn't it in there? He's also a cheapskate like me. Nvidia, Apple. So you can see how these have performed over the past. Lots of greens. Ooh, there might be an opportunity there. I think I cover that a little bit later. I'm not getting in yet, just so you know, but that is on the watch list. I can tell you that. These two are too expensive. I will in the future, but not right now. For my clients and myself, but not right now. Okay. JP Morgan, my son has as a 5-year hold, and Goldman Sachs. Why did I do that? Well, when I sold mine, when the daddy bear scenario occurred on the S&P, I didn't sell his because I wanted to make the point to people that you don't have to do 12 months. If you want to be less bureaucratic with your wife and children, spouse and child, you can still hold quality companies for a longer period of time. And I'll then show people how that's worked for him, how it's worked for me, and who won. He's lucky. He'll probably have won. He's been elected to the school council today. He's 7. Be warned for the future. The boy's got political ambitions. Past year, okay, the last 12 months, Apple's up 14, Microsoft's up 9, Oracle's up 28, Palantir 382%, Nvidia brought a lot of green, basically. Tesla's up 52% over the past year. Not what you'd think if you thought about headlines, is it? No. That's why I prefer data over headline narratives, because the narrative, if I asked a random group of people in the street, what do you think Tesla's stock price is over the last 12 months? They'd probably say, oh, it's crashed and burnt, but it hasn't. Thank you, Brenton. So lots of green. Now, this makes my life a lot easier. It makes me look smarter than I am. I'm not that clever. As Warren Buffett said, he's not that bright. He just rides the coattails of some of the best companies in the world. That's all I'm doing. And taking credit for it. Okay, because the modeling career didn't really work out for me. So ETF 1 month performance. I'll do a separate one on exchange traded funds. Bloody hell, lots of green this week, eh? Over the past month. Too much to talk about. I won't necessarily talk about that right now. But if you want to know, that's the Brazil one, and that's the India one. I think I did. Let me see. Actually, I might just do it. I'm feeling good. I might just put up the India one. Right now. 2 of my business partners are in India at the moment. We're launching an institutional India fund in Zurich next week. So I'm going to fly out to Zurich next week, but it's institutional. But anyway, here it is. There's the India one. Ooh, it is flattening out nicely. So I would say, I mean, look, it might be like this, like here where, it looked flat, and you still had a whole year of 0% returns from September 2022 to June 2023, well, even longer, to September 2023. So you had 12 months of 0%. So I'd say I'm going to wait a little bit because we've been here before at this level where it just went sideways, although it looks okay. But yeah, so if somebody bought it, I'd probably say go in with 10%, wait a month or 2 weeks, add to winners. Oh, you could add to losers as well if you were going to hold it for a longer term. But that's definitely going to give you, if I can do it, let's say you did do a long position on it, I would certainly be definitely, of course, targeting the all-time high, which is only 11% higher. I wouldn't put a stop on it, but anyway, but not right now. I think I'd rather just wait. I know what you're thinking. Why do you keep waiting? It's going to be this year the 4th largest economy in the world, the same size as China. Same size as Japan, $4.2 trillion. It's already bigger than the UK, and it produces in GDP growth alone each year a new Pakistan every single year. It's what it produces, to keep it topical. But not yet. Have a look at EWZ as well if you wish. You can do that on Google Finance for free. You can do it on Yahoo Finance, what I just showed. You can put up on both of those. But like I said, I'd rather wait. The reason I'm rather waiting and getting you ready is please be patient, because there's going to be gains to be had. That's the message. That's what's happening with my pension. I don't mind waiting because I know my pension is accumulating potential energy. Okay, it doesn't always have to be kinetic energy and just doing something. This is where we are over the past year. The S&P, like I said, still closer to that scenario, okay, which when that happened last time, that's what happened. Doesn't mean it's going to happen again. It might be more like this, and we might already have seen the bottom. It might be a V-shaped recovery. I do not know. I didn't know here, and I didn't know there. All I know is I think I'll just wait till Friday before I make any other decisions. That's all. That's it. Crystal balls and time machines are not my business. Okay. And I know I've won competitions forecasting the markets and all the rest of it, but that's not what I want to do here. I don't want to say to you, here's a forecast. What I'd rather say to you is, hey, it's Wednesday. Let's wait till Friday because that looks like that, and I'd rather wait. Okay. FTSE, yeah, if you bought it down there, you would have been laughing. But this looks like it might just chug along and then go up. I won't be surprised if it makes an all-time high this year. The Dow, 52% think it'll be higher as well. Raheem, what do you think of moving money to high-yield dividend stocks for the time being? So I've written about stocks playing for dividends. I think on my blog, the problem can be if you can get 4.4% on a bank account interest, okay, at the moment. So if you're looking for a greater yield than that, the problem is if the stock drops, then you're stuck with a capital loss unless you're going to hold that stock forever and the yield is going to be maintained. In which case, great. If you can find a 10% yield and the company is guaranteed to make that every year and its stock price, then its stock price movements are irrelevant because then the stock becomes like a bond. Okay? So, but if you're planning to hold it for a year, then you're taking a massive risk because if in a year you make 10% on the yield and lose 50% on the stock, great. Okay, so it's got to be the kind of company you don't mind holding forever, which again, why Warren Buffett makes his life very easy and says, my holding period is forever, because guess what? He's unshackled himself from any of the problems everybody else faces, which is trying to predict in the short term. The genius of the man is the simplicity, but genius is often simplicity. This is going to double my money. It's going to go from about 1,500 to over 3,000, but not yet. I'm not going to do it yet. I'm going to wait. Why do I wait? Well, because I like to wait with these. It's a 2 times leverage ETP. Don't do it yourself. Okay, don't you do it because it's leverage. So you shouldn't do it because you can easily lose half your money, half your pension within 6 months, 12 months. Okay, so you shouldn't do that. I don't mind because I have the time to look at these things. Okay. This will also be very lucrative for me, but not right now. Why do I say so? Well, because I think there's a future in semiconductors. What do you think? I went forward in my time machine, and apparently we're still using them in the future. But until this flattens out, all this is short and medium-term average prices. Okay, that's all. It's not voodoo looking at charts. I'm not looking at chart patterns of reverse head and shoulders and triangles and all of those, although some of those sometimes work. And this isn't guaranteed to work either. It's just short and medium-term prices, just where people are putting their money. And on the whole, we know they tend to put their money in that direction. But at the moment, I'm still going to wait because I'm going to see if I can pick it up cheaper. Okay, maybe when it drops, certainly when it drops below there, well, when it flattens, we'll see. Because look, could have bought it at 126, but wouldn't you prefer to buy it, say, at 102 instead? Yeah, I'm cheap like that. I rather would. I could buy it now if I wanted, and you know what the risk is of doing that, getting in too early. Okay, Alphabet, phenomenal. This is definitely going to, again, it's going to double my money because it has done time and again. But at the moment, I'm going to wait. All right, but it's definitely going to double my money because it's done it before. And this is how historically, doesn't mean it's going to do it in the future. It tends to move. And here's the problem where people panic. See that? Over 20 days, there's a small probability, and that causes even more panic because it's unexpected, of a 19% drop. When that happens, that's when people panic, and that's why they can't get to the 250 days. Now, never get panicked, but also, you know what else happens? You might end up here after 250 days. You end up with a 0% return, so you get bored. Boredom and panic are the 2 reasons they F it up. And then the next year, when it goes up 64%, they've left. So the only time so you've got 2 options. either buy and hold for the long term when you find a formula like this, and there's very few companies which have profiles like this. Most of them have really erratic, crazy profiles because they're not good companies. Or use the daddy bear rule, which is what I tend to use because I like to be more dipping in a net. Okay, so I tell my clients quality 5+, use the daddy bear rule, double leverage when it's not in a daddy bear if you've got more risk appetite. Simple. And one of the model portfolios. Simple. What some of them like to do, which is more than welcome to do, is pick themselves. So it's a bit like, think of cakes, making cakes. I can either give them the raw ingredients like here and then tell them what the recipe is here, but then often through panic and boredom, they'll mess it up, not hold long enough, not put it in the oven long enough to grow. And so a lot of them say, look, can you just make the cake for me? So we say, right, let's work out your risk profile. What flavors do you like? Oh, you've got this risk appetite. You want 32%, but I'm sorry, I can only do it with a 20% volatility. Ooh, damn. No, Alpesh, can you then reduce the returns because I want less volatility? Exactly, and make that bespoke for them and then show them how it performed historically, how it would possibly do in the future. Not yet. Occidental, Buffett's got a load. I know that's going to double my money at some point, but I'm not going to get in yet. That might have bottomed, but I'm just going to wait. And I'll keep watching this for you, but I'm just going to wait. It's done it. Oh, look at that, eh? But I'm going to wait. I'm going to wait. Now, I could give you a whole load of macroeconomic analysis about how OPEC just had a meeting and are flooding the market with cheaper oil or driving down the price of oil because they want to punish the Kazakhstanis who have been secretly producing more oil than they should have been and breaking the OPEC cartel. I've spoken about this on the BBC as well. But no, narratives is not the base on which I pick stocks. Okay, Alpesh, are those histograms on a rolling basis or a longer period? These are over the last 2 years from today. So this is 5 years. 5 years. 5 years. Okay, so this is Occidental, and that's how it looks. Now, Occidental's a bit of a mess. So it's not one of my quality 5 because it doesn't look at that. It doesn't look anything like that, does it? That's what I want. Not guaranteed to happen in the future. Stocks have prices. Prices means statistics. Statistics means there's opportunities to look at data, test data, and make money. Okay, so that's another way beyond this. This is also statistics. This is taken from the 3 sets of accounts all companies have: P&L, balance sheet, cash flow statement. We take all 3 of those, we extract out what's most important, do all the donkey work for you, and then say, right, okay, that data suggests these are good companies I want to hold forever. Let's look at Berkshire Hathaway. Now, with Berkshire Hathaway, when I think it was here, so January 2024, I said, overbought, I'm sorry. No, not for me. And what did it do? Look at that. So I missed that, sadly. With Berkshire Hathaway, it's a bit overbought at the moment. Does that mean it's going to fall? Not necessarily. Not necessarily. But what tends to happen is there's a greater probability of this happening when this is overbought, like here. Not always, because it hasn't done here at all. So well done, Alpesh. Well, no, because if it was guaranteed, I'd be king of the world. So I tend not to when it's like this. It's not like that at the moment. So the big question is, would I buy it now? Well, no, because it's overbought. So sorry, no. If you wanted to, I'd say go in with 10%, see how you feel, dollar cost average in, or add to winners in. Adding to winners is more the hedge fund strategy. Dollar cost average is more conventional. If I already owned it, well, forget that and forget that. So, and this is amazing. It's one of the ones which I would be willing to do 2 times if there is a 2 times leverage ETF on it, because those numbers are phenomenal. -7, -8, -6, -2. The guy's a genius. There's very few companies like this, and 2 times leverage on that, I'm happy to do. I'm just not comfortable doing it today. Okay, so with my clients, I tell them, look, when it's out of the daddy bear, if you want to do 2 times leverage because you're higher risk with 10% of your capital, feel free on this and the other quality 5+. But don't do it when you're too late into it, because the risk you have is you got too late to the party and you're going to get your fingers burnt. Okay, or if you're going to do it when you're late to it, just edge in and keep a closer eye on it because you're late to it. That's why basically, essentially, this is what I tell clients. if you suddenly do become risk averse, I love flow charts because process avoids emotion. So all clients get processes so that it avoids emotions and they always know what to do. If you're doing this and getting out because you suddenly turn risk averse, just be careful you don't overtrade your portfolio too much. And if you're willing to hold, always have something which you bought for 12 months but are willing to hold for 5 if you have to. Very much a Warren Buffett rule, but I happen to agree with it as well. Sorry, that should be down there. Okay, where am I at the moment? I'm here. I'm sort of still waiting a little bit. I'm being more risk averse. I don't think I've got any clients who are doing this. I know some are getting very anxious because they really want to get in, which they can, but I'd say if they're going to get in, edge in, do the dollar cost average thing in this kind of environment, be here, don't necessarily be in here. Okay, JP Morgan, my son continues to hold, and he's going to be a very rich boy as a result. Oh, because he's only 7, and I know which way this is going to go over that period of time. You know, that's what's going to happen. He's going to get a few years like that. He's going to get a few years like that. And yeah, he's going to get a few years where he gets bugger all. Well, generally, if he gets that over a period of time, he's happy. Okay, I want to show you the quality 5. I normally keep this for clients, but just show you how we're doing so far, because I talk about this very often. And if we assume we didn't apply the Daddy Bear rule, which you're familiar with and I've explained very often, okay, this has been its annualized return. Now, with the Daddy Bear rule, it's actually been better than that. With 2 times leverage, it's been even better. I've got closer to 40% in some years. Not every year, because 2022 had bugger all. Okay, but this is the problem. That's the problem. Okay, so just so you know, with the quality 5 plus, and that's the bit where people will panic. That's the people where people will panic. I'll give you a classic example of this. Microsoft in 2021 went up 50%, but for 9 of those 12 months, it was negative or 0. Got it? 9 of 12 months, it was negative or 0, but it went up 50% overall that year. So boredom would have kicked in, and the times it fell, panic would have kicked in, but it went up 50%. So what we try and teach clients so much time spent, and I spend even more now because I've learned that you really need to keep talking to them about this, is what this means. So now we actually show them specifically with charts and images what that means, because everybody focuses on this and gets ridiculously greedy about that. And if we apply the Daddy Bear rule, those returns get even better, but some don't have the time to do it. Okay, the mental strength to do it, which is fine, but that's my job. I also did this. I created for clients from all my writings, all my books, 2 slides. Okay, I put everything into just 2 slides. These were the only, I say to them, if you want less material, these are the only 2 things you need to get up, and each one of these is a video, to get up to speed. I thought, right, why not compress everything into something small? So I know where the money's going to come from. This is the biggest problem people have. They start panic buying. They have no strategy while they're buying it. I had one client today saying, oh, I like this, what do you think? I said, well, what's the strategy? You might well be right, it's a good company, but if you want to put it into your miscellaneous, you know, keep it hidden from the wife, miscellaneous shit, then feel free. But if you haven't got a strategy, you're going to at some point get bored or panic. Okay, boredom and panic. Generally, if I'm looking at medium to high risk clients, they'll want 20 to 40 stocks. If we're looking at lower risk, they'll want more exchange traded funds because they have less volatility. The beauty of exchange traded funds is they have less volatility. And we have data on 6,000 of those that we go through and we say, right, let's work out the ones which have got the highest returns. Okay, exchange traded funds, the high Sortinos. Now, Sortino is a hedge fund calculation. We want the ones with the high Sortinos. We want all of this to be green, by the way. We want high Sortinos. Why high Sortinos? Because that means high average returns with low downside volatility. Now, I want to teach you a few things whilst I've got you here, please, if you don't mind, on this while we talk about markets as well. Is you work out your risk appetite. Once you've worked that out, that's the most important thing. Not how much money you want to make, but how much risk you're taking. And then we maximize for the returns possible. But exchange traded funds are often overlooked. Okay. The other problem is they don't know when to exit. So we generally have a 12-month rule. However, increasingly, I've got clients saying, well, God, that time flies, and these are really good companies, and they didn't necessarily have a good year. Let's hold on for longer. So we want them to make sure that they're companies which they're happy to hold longer if they need to, but they need to have a strategy. Once we've got it all filtered, if you then want to narrow it down, I sometimes well, I say to clients that if you want to narrow it down, once you've got a filtered list from 10,000 down to 200 suitable companies, there's a number of ways in which to do it. Okay. And by the way, if you go here, you can download free copies of each of these. Okay. Free copies of each of these. And they're really good books. This one, obviously, you'll have probably hopefully come across. The Intelligent Investor preface and appendix by, sorry, that's weird, preface and appendix by Warren Buffett. I don't think they'd do the appendix, but anyway. Okay, you can download them from there for free. Okay, that one's by me. Okay, for free. Okay. So what I wanted to show was once we've filtered that down, some of my students will say, well, I need a tie break now. What shall I do? And I said, well, let's have a look at what some of the gurus are buying. And I'll show you, this is old, because I wanted to show you we have the same consistent approach as we did 5 years ago, 10 years ago, 15 years ago. And it might be that they go across, see what the richest have, and they say, "Ooh, Alpesh, on your filter, you've got Apple, they've got Apple. I think I'll have that, or Bank of America, or Coca-Cola, or American Express, or whatever else." Okay, this is old, by the way, so don't follow this today. We update this for them. But that's one tiebreaker. Another way they can tiebreak once they've filtered it down is we'll go through and see what some of the biggest hedge funds have got. This is an old one, and say, "Look, we've got this. The hedge funds have got this. It's on our filters. It's on theirs. All other things being equal, let's go and break the tie with that." That became ridiculously good for us in that year, at that period, as a result of that. It was on our filtered, it was also on some of the hedge funds. Leveraging on lower risk. So this is old. This is old. So for instance, some of these, and you can see the leverage there. I'll only ever do 3 times leverage on the S&P. Okay, Amazon, Microsoft, and that worked out rather well. Okay. Saving cash, losing money big time. Brendan Keith. I kept thinking it was a blip and would recover by the time it went into cash. It was pretty much where I was when I invested 3 years ago. So it was 4 case. Hoping I can get back to make up. Yes. Keith, tell me which ones. Martin, qualify with Daddy Bear rule of 25% or 35%. No. It's just a Daddy Bear rule. There is no 25 or 35 with it. What banks tell the richest clients? That's another way. Okay, so I want to show you the consistency of what we've been saying. Take this, April 2022 said, okay, it's on our filters, but also the analysts at the banks seem to think on average it'll go from 42 to 78, and then it jumped up and did actually give a 50% return. I didn't know it was going to go up that much. I didn't have that kind of knowledge. April 2020, similarly, this was on the filter, but we said we need a tie break. I didn't know it was going to give a 250% return. If I knew that, I would have gone to Ladbrokes and made a massive killing. We did know some of these stuff, but we didn't know definitely to go in March 2020. So it can go from 99 to 144, 73%, because we needed a tie break. And since then, that's why we held the 12-month rule. It went up, then it went back down, went up, went back down. 12-month rule can be useful for that as well. This is Uber Technologies, bloody hell. So it can go from 27 to 43, then it jumped up, but 12-month rule was for that reason, because just as they over exceed, they can drop back. Okay, and this is how we did the same with Viacom, did the tie break. And sometimes the tie breaks are pretty good by doing it this way. United Health, which has dropped 12-month rule. Why? Well, because of that reason, that after that period, anything could happen. Now, if you don't want to do a 12-month rule, and sometimes we'll look at what the analysts at the biggest banks are saying and their targets, because you're thinking it's too risky, then you elongate your time frame and have something more of a model portfolio. But what you don't do is have no strategy and just jump about. Okay, that doesn't make sense. Just no strategy and jump about. And we can get the data from various sources for all of that. We're just riding the coattails, and we'll look at those as well. As a tie break, the core analysis, just so you know, is this. It's the spreadsheet to look at what are we ticking. And we'll look at what's the working capital, all of this, and see, does it meet those links? Or more importantly, this from I really love because of the 30% per annum. We look at research from other people. Because they're cleverer than me. So why wouldn't I? Okay, continue to look good value at the moment. I'm holding short, saving cash, losing money big time. I don't understand, Brendan. You said you're in cash and losing money at the same time. I can't think it was Keith, which one's a blip? As well. So that's why we tick that box on Croaky. It doesn't guarantee, but it avoids making stupid mistakes. My job, like Warren Buffett's, is to not make any stupid mistakes, not pick something and then go, what the hell, we should have seen that wasn't going to do well. If we pick something and suddenly Donald Trump does a tweet, that's fine, because that's not stupid. Oh, sorry, Brendan, it's cash since 2022. Understood, oh my lord. Yeah. Sean, I think it's fine if you're holding Amazon. If your time frame is longer, then it's perfectly fine to be holding it. But don't panic if it drops a few percentage here and there on the way. Let me put it this way. Chances are today is not the lowest price Amazon's ever going to see. That's just statistics. Okay. That for me was the critical thing. These are the most loved by hedge funds. Now, I know where I'll be making the money. It will be on Amazon, Meta, Microsoft. At the right time, Nvidia, Alphabet, Apple, Taiwan Semi, MasterCard, Visa to a lesser extent, Berkshire, Eli. That's too volatile, Alibaba, for me. And AppLovin's a bit volatile, but I like talking about it for other people. Flutter, one of my clients, absolutely loves and says it's just ridiculously good. And I did some analysis for him, and I don't have a problem with that. It's just that I've got enough choice already elsewhere. Okay. The typical profile of a bear market, according to Goldman Sachs, is this. Okay. Goes up, down, then you get this. We are in this volatile period at the moment. That doesn't mean we're going to have this drop. Doesn't mean that at all. Technically, we hit a bear market intraday. If you count that, we dropped peak to trough the S&P 20% intraday, but it didn't close below 20%. So was it a bear market this year or not? Difficult to say, because intraday it did peak lower and then bounced up. I don't know if it's going to drop lower. I'm just waiting. That's all. We might already have hit the bottom. Ravi, if you're on, you often are. We used to give medals to our students who got great returns with the program, because some of them did things and picked ones which better than I did. If you go back and look at Crocs, that's when Ravi got the thing, you will see why we have the 12-month rule, because then it fell off a bit and he didn't want to wait for the loss. So he exited 25% from the peak, some of his holding. Actually, once he doubled his money, he exited, I think it was half his money half his money when he spoke to me, and then the other half when it dropped 25%, something like that. And showing those strategies to make it bespoke for clients is really important. Do follow me on LinkedIn, don't forget. And on here, you've got a ton of resources on improving your pension and free downloads, the free books that I've already mentioned. I want to answer your questions and also go a bit more into why your pension fund, IFAs, and wealth managers might be destroying your returns. One of the key reasons is they're tied to geographies. So they can only pick stocks. Two main reasons they lose money for you. And Eugene Febber got the Nobel Prize in economics for this. One, they can only pick from a narrow list because they've got a UK fund or an AI fund. So it's like saying I'll only pick the best footballers from Watford. Okay. Even Liverpool doesn't pick the best footballers from Liverpool. Okay. It picks it from the bloody world. Right. So they're not that stupid. Neither is any football team. Okay. They stopped doing that stupidity a long time ago. So that's the first problem that they have. Hands tied. Why? Because it's a marketing gimmick to be able to say, oh, we've got a UK fund and but nobody ever points out to them the obvious bloody thing. Well, you're basically saying I'm going to pick the best people out of Watford to play international football. Stupid. Okay. So that's the first thing. The second thing is they can't go into cash in years like 2022. And so they end up losing lots of money, which is why Scottish Mortgage Investment Trust lost a lot of money. Why companies like 91, which is very popular in markets like crazy and gets all these little diamonds and A stars and everything else over 3 years, gets you minus 2.3%. This is when one of my clients joined and he showed me this. That was in 2020. It's one of the earliest clients, and he joined and he showed me this. And I said, bloody hell, you've got nothing over 3 years. What the hell? You can see I've done a video for him there. It's me doing the video. Jeez, time flies. I want to show you something else. So we picked a bunch of February ones for clients. Our February picks, i.e. when the market was at a peak. So I don't want you to think, Alpesh, you smart ass. No, before the market peaked, with the highest volatility ones from our filtered list. So all filtered down. Okay. That has historically returned 30.9%, but it's volatile. Okay, and we've got that because we picked purposely the most volatile ones. Okay, that is not suitable for most people. I'll tell you exactly how many people that would be suitable for. Probably about 10% of my clients, if that, maybe 5. My point to you is this: the vast majority of clients would far, and rightly so, have this number go down and this number go down, even if it meant this number goes down. Can you understand that? This is probably the most important thing I'm going to tell you all evening. They would far rather have this number go down and this number go down so they don't panic, even if it meant this number goes down. By the way, 15% per annum. So if you were to halve this, that would double your money in 5 years. Okay? 15% per annum. Okay? Even if I said to you, well, what if you halve this and halve this? You'd say, okay, I'll take that. Do you see what I mean? And that's important. Even though you're largely in cash, are you still picking stocks each month from your list? No, because I'm in cash. Okay. So I mean, I give them to clients and say to them, look, this is good. I don't mind you buying it. And I've told you some of them today, all the ones I've mentioned today. I don't mind you buying them if you want. I just, I'd rather wait. Not because they're bad companies, not because I think the market's going to crash, but because what I'm trying to get across to people is you're not trying to be me. I know it's very flattering that people want to be me. And if the old guru said it, the mighty pundit says it, sitting on the mountain, it must be true and he's seen the future. I haven't. What I'm trying to get you to do is the same thing Warren Buffett's been trying to get you to do, is focus on those quality companies and say, right, now I think I would rather get in. That's all. And I tend to get in late and out late. So if that's the movement of a stock, I tend to get in here and out here. And I've written about this in my books. Okay. Financial Times published books, I might say, not just self-published. I've never self-published. Okay. That tends to be me. Most private investors make the mistake of trying to get in here. And then they panic because of this, or they get bored. That's I should give that a name. The death curve of panic and boredom in investing is that. And that's what screws up private investors. Whereas when you're in cash, your stress levels are 0. Okay. My stress levels went up today because my bloody business partner, they're traveling. I called them up. They're in India. And I thought, what the? We've got a meeting next week in Zurich. And I got a feeling they're going to be stuck. Well, they're not going to be stuck, actually. Okay. So that's me. I'm trying to teach you these things because they're really important. So if we create a portfolio there, and this is the returns, and that's the volatilities, what I want to get to is not that what these best years were. Ignore that. I want you to look at this. This is when people panic. But look at these best years and the maximum drawdowns of the individual stocks. I want you to look at these. The names don't matter. You went, oh, they matter, they matter. No, they don't bloody matter. What matters is that this is what 31%, that's doubling your money in 2.5 years. This is what it looks like. That, I want you to focus on the drawdown and the worst years. This is where your panic will happen, and why giving you that will have 0 impact on you other than give you stress. Because what did I say? This is where your panic happens, okay? And less than 10% of my clients would want that because they don't want this. So we create for them milder versions with half of this return, half of that, half of this, actually slightly 20%, and half this and half that, because it can be done, thankfully. Okay? That's what people don't get. Glyn, gold miners, they don't seem to correlate to gold, and gold is overbought. Is all I can say. Will it continue going up? I don't know, but it's overbought at the moment, so it's not for me at the moment. My wife bought, as many of you will know, from this physical gold coins last December. We don't keep them at home. Only investment decision she's ever made. So my plan, assume you plan to invest over 15 years. Notice how I've been saying 15 years, not 5 minutes, not 1 year. Okay, and a lot of people say, well, that's fine. I'm old, but I'll give it to my children. I'll teach them this and leave it for them. Great. And with my help, let's say you got closer to that 20. Okay, and let's say you got that, you got this. That gets you to 66, from 10,000 gets you to 600K in 15 years. 10,000 becomes 600K. I've been showing this for year after year after year. Why don't people do it? Actually, we're about here now on it. Why don't people do it? Because you're only there. Most people want to be here, but that comes later in life. When you put your feet up in the beach in Bali is here. These are the working, boring years. That's the beach in Bali years. Okay. That means at that point, my son making whatever, $250,000 a year sitting on his behind by the time he goes to university. Great. These are a range of portfolios that we have engineered and not managed to engineer. We have not managed to engineer this one. That's the dream. Okay? Just so you know, that's the dream. If I do it, I'll get the Nobel Prize in economics, guaranteed, if I can create portfolio number 21 over a prolonged period of time. Excuse me. Why? Because I could double money in 2.3 years, and the probability of being down after 1 year or 2 years is 0. Okay? If I can create that, I'll get the Nobel Prize in economics. We're engineering it. We're working on it. Far more reasonable is some of these you don't want. So we get rid of these. We don't want these. Okay, we want closer to these. That's a good low risk one. Double your money in 4.6 years, 15% annualized. Volatility less, the return same as the S&P, but volatility less than the S&P. Well, why don't I just do the S&P, mate? Because you'd like less volatility, wouldn't you? Why would you like less volatility? Because then you're less likely to be down. That's why. People don't understand. What's volatility? Probability of being down. What's return? How quickly you can double your money. Another way to look at it, which is what I prefer. 12's a pretty good one that we got. 20 and 15, 3.47 years. Still a 10% chance you might be down in a year. Okay. We've got something close to this. It's not exactly like this. It's got the 20, but it's not got the 10. It's slightly above 10, okay, on volatility. All right. Or you can just make it yourself. We've got clients actually who've done some amazing portfolios, which we haven't done, where they've created it. And they've got some amazing cherry picking because they've gone through all the, it's like I give them a set of ingredients and they make a better cake than I did with the ingredients. Good. Boredom and panic. Those are the two reasons you're going to mess up a good investment. Out of 10,000 securities listed on the London Stock Exchange and the New York Stock Exchange and NASDAQ, which can be in your SIP or ISA, there's only about 200 worth considering. Okay, only 200 worth considering. The rest will kill you. That was the Microsoft thing. Look at that, up 50% in 12 months, but 9 out of 12 months was down or flat. I said I've done this already. I've done that. That's what worries me. That's what worries me. That is what worries me. The people who are at St. James's Place, I want to take all their clients away. They've got 900,000 clients, no, 980,000 clients. I want to take all their clients away because I've only ever met one who was happy with them. And I think that person was working in management. Okay. So what we do, that's what we do, as you know. Just break it down. Think about it. It's obvious. It's obvious and it's simple. Undervalued companies that are growing, producing a bit of income with good momentum and statistics. That's it. That's what it's about. Now I want to show you this. What has worked in investing? They're not the only ones to have produced it, but that's the kind of stuff we look at. We look at the data and we look at the research to that. Okay. Now I said this. All of what I'm telling you now, I said, there you go. 1999. That's what I used to look like. Ooh, okay. I'll set up my entire UK holdings and buy only US stocks. And it was the choice. It was the choice. Okay. It was the choice that I had. How's the last 26 years been? Bloody amazing. That's it. That's it. But that's how last year went. Last year was lucky in a way because Trump wasn't in the White House. If he was in the White House last year, wouldn't have been lucky, would it? So it was a good year. So it was 2023. 2022 was mainly cash. That's how it is. That's how it goes. These were some of the good ones. I don't have to be smarter than everyone else. I just have to be more disciplined and process driven. It's as simple as that. That's the process, the knowledge I give the clients. Don't worry about all of that. I'm going to answer your questions. You want to go there. If you want to be part of the program, there's a lot of free tools. Go for the free stuff here. If you don't want to be free, 10% of you want to be on the program, usually is what I find on a call. Then do that by going to that link and join up. Don't need to worry about all of those things that we do and all of this. That just be aware of these kind of people. Scottish Mortgage Investment Trust 2022, that's what they do with your pension. Look at that. That's what they do. Why? Because they can't hold cash, because it's prohibited for them to hold cash. They have to be invested. And so they drag the results lower, and because they're restricted in what they can buy. You're not. So they'll F it up. That's the experts. That's the professionals. Can you believe it? That's what the professionals look like. I can't believe it. I'm going to send you the file to the book as well. That's what the professionals look like. So just be careful. If you want to join the program, my aim is to eventually float this company. I set up the Hedge fund about 20 odd years ago, but that's institutional. Retail I've been doing since 25 years when I wrote my first book, 27 years ago, when I wrote my columns. I want to take this company, I want to take all the clients from St. James's Place, take this company to the stock market. And I've spoken to the London Stock Exchange already, as you'll know if you follow my social media. Okay. And I want to do it differently to anything that's out there. This is not like anything you've ever seen. We don't give you stock tips. We give you all the data and give you unlimited access to me for the first 350 clients and no subscription fees. So lifetime data, lifetime access to me, but only for the first 350 people, taken in batches of 10. And the reason we do that is I want to make sure we've got an ample, solid base of case studies to share, to say, both to venture capital investors and the market, this works. St. James's Place is a FTSE 250 or FTSE 100 company. I think that should be replaced by people who've got the power to do it themselves through the data and through the knowledge. I want to give people the power and the data to do it themselves. Democratize investing might be a pompous way of putting it. But by not charging a fee each day, each week, each month, but just a one-off, I want to turn the whole industry on its head. I don't want to have my hand in people's pockets every single day for the rest of their lives, as the fund management industry does. I want to give them lifetime access to both the know-how and the communication from me daily, okay? Because IFAs and wealth managers don't communicate, so they're not trusted, okay? And they don't give you the data and the knowledge. So you're basically beholden to them, and then they charge you for the rest of your life. It is useless. It is rubbish. Okay, they don't make a bespoke portfolio for you. They shove you into a bunch of funds which are pre-existing, created for different baskets. So you end up getting in it whenever they tell you, as opposed to, well, actually, maybe you want these stocks suited. So create a model fund just for you. You know, the Raheem fund, the Malcolm fund, the Glyn fund, the Brendan fund, instead suited to them. It does need to be in secondary education, because we'd have a far wealthier country if it was, because people are getting screwed on their pensions in the UK. The Americans are getting richer, so they're retiring richer. The Brits are getting 2% because the investment trusts are basically index trackers, and they're tracking 2% over the last 10 years. So the Brits are basically earning a salary to pay fund managers money, and you're basically feeding those fund managers, and that's why they are poor. Any such recommend beginner data? Google Finance, Yahoo Finance, okay, Portfolio Labs I've not seen, but yeah. Risk metrics. By the way, you've mentioned the word risk metrics. Risk metrics used to be a really good site created by JP Morgan. Unfortunately, it went away. But have a look at Yahoo Finance and Google Finance. They're rather good. Simply Wall Street's good. Simplywall.st is good, but there's a danger you get confused with too much stuff there. But yeah, simplywall.street is good. I found some of the older websites listed don't exist, but give me the to become less ignorant. Thank you, Malcolm. Yeah, I've got to update the books. I haven't got the energy at the moment to update some of the books, sadly. But I probably will in retirement. So anyway, if you want to sign up to it, let me know. I'm going to answer any questions as well. That's where you go. If you'd like a tour, let me know. Paresh will give you a tour. We'll set up a call as well. Don't forget to follow on LinkedIn as well. Okay. Oh, I'm a top voice now. I forgot to mention that. Yeah, they give me that because I post quite a few columns and articles. So you'll find some useful ones there. This one I've just posted today on investment trusts and why they just lose so much money for clients, the amount of wealth damage that they do. It is absolutely shocking how much money people lose as a result on there. That's my son looking at his dad on Beep yesterday. Okay. Also, I've got some free columns. If you go to alpeshpatel.com/shares, you will see some free articles which are really useful. I think they're very useful. These cleaning up portfolio messes, why pensions only up 20% in 10 years, and that's if you're lucky. The market's up 400%, and so on. So what happens, and what happens with some of the pensions, and how the IFAs are messing things up for people, sadly, as well. On that, if there's any questions I missed, tell me. Alpesh, would you mind going back to your JP Morgan slide, please? I like the idea for my children. Certainly, the trick's going to be, Glyn, whether it's Goldman Sachs or JP Morgan or Amazon, Alphabet, Apple, Microsoft, panic and boredom. Okay, your kids are going to look at that at one stage and say, Mama, it's been 2 years, I've not made any money. So that's why you'll get out too early. Warren Buffett's holding time forever. Or panic. There'll come a day where it drops. I don't know where the JP Morgan one is. It drops 10%. And there'll be panic. Actually, let me just show you on the screen instead. Let me just pull it up. Okay, so just be careful about that. But I've held it longer term for my son. I'll probably do some 5-year ones just to show people that you don't have to hold for a year. And I'll probably do a similar thing for my wife and so on as well. Okay. You've all been rather good being so patient and being on here. Let me just show you on here. Alpesh, is it FinViz where one gets the data for share value? I share value. I think Yahoo has it, doesn't it? Oh God, what's happened here? Did I press on? Oh no, there we go. JP Morgan. Used to trade their options a lot. So there we go. Now, the biggest danger you're going to have with this over the long term, Glenn, is that, okay, this can drop 40%, even though, okay, so it's not suitable, even though you can go up 298 over 11, what's that? 8 years, 9 years. 9 years is a long time. People get bored. So those are the panic stations that happen in between. But if you're holding for the long term, you'll say, well, okay, I know what's happening because I can see the momentum dropping. And that's the danger. It might do that again, for all I know. But if you're holding for that long period, then buying into it during that period is not necessarily a bad thing. Overall, as long as you believe there's a net positive return to be had. The problem is people start doubting themselves with quality companies when they drop like this. And let's say it does, and here's the other place you'll get boredom. Let's see. See that? 4 years, 0% return, more. Okay, so maybe not necessarily JP Morgan. I'm holding it for the longer term for my son because I just want to prove the point to my clients that, you know, everything doesn't have to be 12 months. 12 months is the standard thing for our filtered list, but it doesn't have to be if you've got the patience to wait. It's just that I assume most people don't have the patience to wait. Look at that. 4.5 years. Are you sure you want it? So that's your boredom, why you exited, and there's your panic. Okay? So there's your boredom and your panic. So there's no point me saying to you, oh, look, buy this. You could have got 250% in 8 years. People don't do that. Real humans, that's why Warren Buffett was so rich, because he had the ability to sustain long periods of boredom and long periods of panic. Simple as that. See? Incredible, isn't it? And just look at that much money. So if I say to you, there's not much point saying to you, in 2009, you could have had it for $23. Why isn't everybody rich? That's a tenfold increase in your money in 15 years. So 100,000 became 1 million. in 15 years. 100,000 became a million. Your 100,000 pension became a million. How come everybody has enough? Boredom and panic. Boredom, panic. That's why. And why did Warren Buffett become the richest man in the world for a time? Because he could withstand that. That's it. That's it. That's it. I've just explained in the simplest of terms. That's it. There's nothing else to explain. There's absolutely nothing else to explain. Just nothing else to explain, I'm afraid. And oh, by the way, I wish I could make that go away. Now, you might say, surely, Alpesh, if we have a portfolio of stocks and not just one, where some went up during that period and others fall, surely that would ease the pain. Exactly correct, which is why he and I don't just have one stock. Although you wouldn't do too badly with just having one stock like a JP Morgan or a Goldman Sachs or an Apple, Amazon, Alphabet. Okay, so what we try and do with clients is manage this expectation, teach them all of this, handhold them through this, okay, so they don't get bored or panic. And it might take 12 months for them to work out their risk appetite, but once they get it right, flying to the horses. I mean, Ravi, classic, is one of my oldest clients. Maybe 12 months, maybe 6 months. Maybe he was a quick learner to work out his risk appetite. Now, over the moon. Can I put small funds with you, Paresh? No, we don't manage other people's money. Sorry, I'll take it offline. Basket case here. Don't worry, Brendan. We don't manage other people's money. We teach you to manage your own capital. That's the whole principle behind it. You should be in control. But there's another reason we don't manage retail client money. A, from a regulatory perspective, it is not worth it, the amount we have to pay. So secondly, it's a lot better for me to say to you, here's my book for free. Here's my webinar for free. Please do it yourself. And also, it's not economically viable. I'd rather just do it for free here. And you might say, well, manage my money for free. Nope. I don't have to be regulated for retail clients. I'm regulated for institution. That's cheap. Regulated for retail. Oh, my Lord. I can't afford that. Thanks for guidance. My SIP is doing much better than my workplace pension, another Scottish company. Thanks, stupid. I know, can I check in with Paresh? You can check anything in with Paresh as well, if you wish. But he can't manage your capital, I can tell you that now. So there we go. He'd go to prison if he managed your capital, just so you know. There's regulations for that. That's why we want you to. It's another reason we want you to do it yourself. Would not want to manage retail client money because it's just not worth it. It's far better to educate them, inform them, and have them do it themselves because it is easy. It's why SIPs were created. But I appreciate some people don't want to do it themselves. Okay, guys, any questions that I've missed, let me know. If there aren't, I shall go as well. If you've got any questions at all, just let me know. But Brendan, do have a look at all the free resources. It is a lot easier than people think. You can really make it simple. One of the ways to make it simple is just elongate your time holding period, but with quality companies. My pleasure, Clovis. I hope you all enjoyed it. I'll send you that link below. Okay, there we go. Sorry, I've got on a bit too much on here. The things that people have liked the most about the program has been there is no ongoing charges. Like I said, I wanted to turn the fund management industry on its absolute head and say, well, okay, why would we ever charge people on an ongoing basis? Costs us, but let's focus on the customer first, on the client first. And that's worked out a treat for us. I think it's been one of the quick things. Just a quick one on uranium outlook, if you have any. I've reached panic on a stock before I found your webinars. If you're looking at uranium and look at the volatility, you will reach panic stations. I don't have an outlook on uranium. I would have thought we're going to use more nuclear power. I just don't. So there's a lot of ways to skin a cat. I tend to go by the data. Okay, I tend not to go by narratives of news stories or my own, I don't know, intellectual curiosity. And you might say, why not? You're a clever chap. there's a picture on Warren Buffett's wall, which is hard work never killed anyone, but I'm not taking any chances. It's the same thing. It's a lot easier to let the computer do the work than me trying to work out what the future looks like in the world. Oh my God, I look at the world and I get pretty depressed trying to work out the world. So, Malcolm, no particular opinion on uranium. No. Glenn, thank you. Have excellent enjoyable as always. Thank you very much. Thank you all. Thank you. Yes, school council. And he was really excited to see Daddy on TV, and Mummy works at number 10 a lot. So we took him once and he's at the gates waving and she's going in. So yeah, I fear the boy's going to get into politics. Oh Lord, it's not a nice profession to get into, given how much, not because of the politicians, a lot of very good people, but just the amount of anger in the world. I don't know about you guys. It's like that thing from Ghostbusters 2. You know, the green bubbly slime, which is every time people get angry, it just piles up. Feels like that in the world. Anyway, okay, guys. Reform, no. Might be reform, who knows? Who knows? Your son should champion financial education. Oh, that's a good idea. Clint, what a fantastic idea. I didn't think of that because he and I do talk about the stock market. That's a good idea. I could just imagine what is the parents calling in saying, oh my God, you're teaching my children to gamble. But that's a very good idea. I'll do that. Financial education more broadly, you know, what are companies, what are stocks? We'll keep it neutral as possible. That's a very good idea. You could route them into Goldman's, may end up in public office later having made their money. My wife was at Deutsche Bank. Oh God. We've got friends at Goldman's. They usually leave. They kill you, these places, the corporates. So yeah, I've got friends at Goldman's, and it's very few. It takes a certain kind of personality to want to stick it through. But same with me and being a barrister. After a while, it was the boredom which just killed me. But with Goldman's, it won't be the boredom. It'll just be this, they own your soul, which it's fine if you like that environment. I'm not. I don't think, Rian definitely doesn't have that. Thank you all. What a fantastic idea. I will do that. I'll tell him that because he is fascinated by companies and how, you know, they do things. So thank you. You're investing for kids. Yeah, that's a good idea. I like that. Basic financial is better than what's already there. No, I think that's a really good idea. Thank you all for that. Fantastic. Okay, I'm going to get going, everyone. Thanks for being on the webinar. Thanks for the council ideas. I'll make sure they know. Make sure he knows. Tomorrow he'll be excited. I know he already is excited. So thank you all for all of that. And I'll leave it at that. Thanks all. I'll see you soon.